Good evening. It's Mark Lewis, your favorite mortgage nerd. Some of you know me as Stewie. Anyway, just want to get this quick video out. Yesterday, I made a video talking about how some changes in student loan guidelines allow more people that have student loan debt to qualify and purchase homes. Somebody brought up a great point, which was, hey, that's fine and dandy, but doesn't that just allow people to prolong debt? Wouldn't it be better for them to pay off their student loans first before purchasing? And I thought that was a great question, and I wanted to make a video to address it. I'm going to try and keep this below 5 minutes, so I don't know, I could probably go longer. Anyway, I want to preface this video by stating that buying a home is a very, very individual, personal thing, that there isn't really a one-size blanket, this is the loan program, the time you should buy, and when you should do it, and where you should do it. I mean, there's just so many different factors that you have to look at before buying a home to figure out if it's the right decision for you at the time you're doing it. But for the simplicity of this video, the main question that I'm trying to address is, if you still have student loan debt, does it make sense to wait to buy a home until you've paid that off? Or should you go ahead and purchase now if that's the only real factor that we're looking at? And it still depends on how long it's going to take you to pay it off, but we're going to go with some averages. And my conclusion is that if it's taking you a long time to pay off the student loan debt, you still have to have a place to live. So the real question is, while you're paying off that other debt, are you renting or are you buying, and which one's better? So we're going to use, just because a lot of people on my Facebook are from Georgia, that's where I'm from, went to school in Atlanta. I'm going to use Atlanta because still got family, friends, a lot of people there. That's going to be my sample city, and I'm just going to use averages to do a comparison. So let's say you're a normal person like me, single guy, you live in Atlanta, $1,350 is the median one-bedroom apartment price. So that's what you're paying. Maybe you got some roommates, maybe you've got another situation, but that's the median one-bedroom apartment price in Atlanta, Georgia. What does that get you in terms of a mortgage payment? Well, just so happens that the median home price in Atlanta is also around $200,000. If you put 5% down, so let's say you just put $10,000 down, your mortgage payment plus your taxes and insurance is also going to be about $1,350. So you could buy a median home, or you could live in a median one-bedroom apartment, and you're going to be paying about the same amount per month. At the end of, or let's say you live in the home for 7 years, which is also an average, kind of a median, how long people tend to stay in one home that they buy. So let's say 7 years, you paid $1,350 a month, even though really rental increases would probably mean you start paying more. We're going to keep it simple. At the end of 7 years, you're going to pay about $113,000 in housing payments. If you were paying that with rent, then maybe you've been contributing a little bit more to your student loans, or you paid them off and you didn't pay the minimum payment every month, but you have nothing really else to show for it except for maybe you had some good memories in the apartment. But let's say you bought this house. Okay, so let's talk about equity buildup. You put that initial $10,000 down on the home, so you had $10,000 to start with in equity. Then you've got, and there's some closing costs and some other factors. So let's say it cancels out that $10,000. Let's say you had $10,000 in closing costs. Probably it wouldn't be that high, but let's say it cancels out. We're only going to measure additional equity. So at the end of 7 years, you're going to have built an additional $26,000 towards the principal. So you've got an additional $26,000 based on that original purchase price. Average appreciation, and it's a little bit higher in Atlanta, but across the board in most places across the U.S., it's about 3% a year. So average appreciation would be 3% of $200,000, the original purchase price, $6,000 times 7 years. Your home value is going to go up to $242,000. I'm not compounding it because I want to keep it simple. So you've got that initial $26,000 down on the principal plus $42,000 in appreciation. So let's do some quick calculations to determine how much better off you are. So let's see, 26 plus the 42 minus the, let's see, the 6%, 242. You're going to pay 6% in probably towards the realtors when you sell the home. So let's subtract about 14,000. So you're left with $54,000 at the end of 7 years. when you sell the home. If you still got student loan debt that you haven't paid off during that time because you were just paying the minimum, you can pay the rest of it off if you were one of those average persons and still have enough left over to put money down on another home. So at the end of 7 years, you paid off your student loans and you own another home. And so, I don't know, you basically ended up $54,000 ahead of the game. You could have still contributed more to those student loans, but just in general, you're going to be better off, all things equal, owning sooner rather than later. And the biggest factor, if you noticed in there, that $42,000 was the appreciation. That's one of the factors that's most rapid. It's not the only reason people buy homes, obviously. Most people, if you're buying a house, maybe you don't care about the appreciation. You just want to live in that house in that area, and maybe it's a depreciating area, but you're buying it because you just want to have your own place and decorate it however you want and change up the carpet and the walls and do whatever you want to it. That's one reason that a lot of people buy homes, is they just want that. They want to own it. And it's more of a personal thing. If you're buying as an investment, then you do want to look for those highly appreciating areas and maybe pick your neighborhood based on a more thorough market analysis. But again, all things equal, if you have to live somewhere while you're paying off your student loans, it makes more sense on average to purchase than to rent.